Thank you for joining us today for our 2023 BSSF Insurance webinar. Before we begin, I have just a couple of housekeeping items to go over. Today's webinar is eligible for 1 CPE credit. In order to receive that credit, you must be active for the full duration of the webinar and answer all 3 of the polling questions, which will appear on your screen throughout the presentation. Each poll question will only be up on your screen for approximately 30 seconds. While the poll question is up, you won't be able to see the PowerPoint, but the slides will come back on your screen as soon as I close the poll question. If you have any issues submitting an answer to a poll question, please just send me a chat using the chat box on your screen as soon as possible with what your answer would have been. Everyone is muted, so please use the chat box to submit polling question issues or any other questions as you have them. You can download the PowerPoint slides through the GoToWebinar panel on your screen under Handouts. We will also be sending out the PowerPoint slides as well as a recording of this webinar to everyone by early next week. Thanks again for joining us. I will now turn things over to Scott Esworthy to introduce our presenters and our agenda.
Okay, thanks, Kayla. Yeah, so basically we're going to go over do a statutory accounting update, covering the blanks working group updates as well. And likewise, Carrie Small is going to go over taxes related to statutory reporting. And then Ryan Perez is going to wrap it up with really the hot topic, if you will, for GAAP this year. It's CECL accounting. So he's going to, even though this is primarily a statutory update, it's such an important GAAP item. We're going to take a few minutes at the end and cover that as well. So with that, I think we're going to go ahead and get started. I'm going to cover the statutory accounting here at the beginning for about 25 minutes or so, and then turn it over to Hank to go into the blanks working group, annual statement changes, and again, tax and GAAP. So starting here on the first page, the sources of this presentation content, especially for the statutory accounting, really it's obviously all coming from the NEIC. The key sources, and what we try to do with our documents here is all the participants give you a tool. When you're done with this presentation, you have something to use. Well, this actually has embedded links. So these 2 light blue links that are underlined, they will take you right to very key statutory accounting update sources to use. And then likewise, a blanks working group update as well. So those are really good links to use. All of this information was accumulated really as of the end of September, October timeframe. So what we did note is there was a fall, they call it a fall, but basically end of November, early December, NEIC accounting, stat accounting meeting that took place. Just yesterday, we went through and reviewed some of those changes, and I will note during my presentation, there's a couple items that were previously exposed that were adopted at that meeting. So I'll just note those as we go versus I'll just note those as we go through the exposed items. Okay, let's go ahead to the next. Yeah, go ahead into the first page there. So these are all the key adoptions. And if this is your first time seeing this webinar, I've done this 3 times this year in the last couple of months. So if it's your first time, I want to make sure to point out some key items. Right here where it says reference number, whenever you're getting into the technical piece of statutory accounting, that is sort of the code, if you will, the key code to look for. That is attached to each sort of accounting concept clarification. So from beginning to end, so when it's just being proposed to ultimately being adopted, it's always referencing this code. So the reference number 2019-21, the reason I'm spelling that one out, that's a really biggie. That one relates to the principal-based bond projects that the NEIC has been going through for a couple years. And so you'll see lots of references to 2019-21, and it all ties back to edits to various SSAPs related to that one big principal-based bond project. So that's what is going on here with the very first item that was adopted, some edits to 26R and 43R related to this. The next item relates to, this is really minor item, but it's a clarification, and it relates to the reference to LIBOR was going to be eliminated altogether, but there's still some old agreements that still reference LIBOR, so they extended it to the end of 24. If we go down to the next, so the next one, C there is SSAP 34. This is getting into basically in regards to paid in kind interest. That's what the focus of this whole one, this entire, I guess, a clarification is about. And so if you see, so basically for 34, this is another item to point out in this presentation. If you see this, if you will, baby blue or lighter blue color that's down at the bottom, this is what this clarification was all about, is adding some additional required disclosure related to investment income due and accrued related to investments related to paid in kind interest. So paid in kind interest is accrued, but sort of rolled up into the principal balance of an investment. So basically the NEIC and SSAPs are asking for more disclosure related to that item. All right, Kayla, you want to go to the next page? Okay. Let's see. So we got, yeah, this is additional item related to more related to paid in kind interest again. So this is sort of giving you an example again in the lighter blue here, the new footnote that's actually required related to disclosing the cumulative amount of paid in kind interest and identifying all these particulars related to this. So this is, again, it's a clarification, so it's not a completely new concept, but it's a new item that was adopted. So if you have investments with paid in kind interest, there's a lot more disclosure related to it. Down at the bottom there, so 43R is getting into loan-backed securities. And basically this is, this clarification, some of these are very, very minor. So this clarification is just spelling out examples of what collateralized loan obligations are. So you can see in blue, that was the revision, just spelling out the different types of collateralized loan obligations, investment types. So, all right, Kayla, let's go to the next page. All right, this one gets into share-based payments. This one is pretty rare, but you know, when you're dealing with stat, it sort of evaluates all the GAAP out there. And so basically this one is sort of focused on in relation to the key revisions for the share-based payments were in the recognition section right here. So you can see in blue, so this is what's being added to SSAP 104R. So you can see for employee and non-employee awards issued in exchange for goods and services at fair value to measure all such liabilities at intrinsic value. However, the reporting shall initially and subsequently measure awards determined to be consideration payable at to a customer at a fair value. So, it's probably rare for most participants on this call, but that's what the clarification was. I'll go to the next item, next page, Kayla. Okay. All right, 25. Okay, this one here is sort of, again, another clarification. And this one's sort of, I don't know, to me, I sort of read this as sort of like pointing out the obvious, but I guess there was some need that the regulators were seeing it come up enough, they needed to point it out. So this one's to clarify that an invested asset held by a reporting entity that is issued by an affiliated entity or which includes the obligations of affiliated entity is an affiliated investment. It's like, aha. So, all right, so basically what I just read to you, that's the edit. That's what they are putting in SSAP 25, which is the SSAP relating to affiliates and other related parties. And then likewise down in the proposed annual statement reporting, there's lots of changes related to this. Literally this sentence and this clarification. So quite a few schedules are being addressed to acknowledge this. So you will see quite a bit
related to that. You can see down at the bottom, SSAP 97, which is your investments in subs. SCAs basically is spelling this out as well. So that's the key clarification they're putting through. Next page, Kayla. Derivatives. All right, so basically, if you do, not many of our clients hold derivatives, but if you do, this is really hyper technical, but basically what this is getting into, it's related to incorporate the portfolio layer method and the partial term hedges for statutory accounting effective at the beginning of the year. So these are two types of valuation methods to use and account for derivatives that was not previously part of statutory accounting. Now it's being added to statutory accounting. So if you go down to this SSAP at the bottom here, this page, what's noted in blue, you can see what is being added to the SSAP. We tried to spell it all out in this presentation. So item D is under paragraph 26 in SSAP 86. And the lead in there is fair value hedges qualify for hedge accounting if all of the following criteria is met. So when you say all, and then they've added quite a few of these blue edits throughout. So again, if you have your derivatives, or if you own derivatives, you should take a close look at those changes, specifically paragraph 26. All right, next item there, Kayla. All right, so this gets into, it's a lot of words here. It looks like there's a whole lot that's being added, but it's a pretty simple concept, I think. It's talking about restricted securities. So what paragraph 15 and 16 are simply spelling out is you can have two types of restrictions. So 15 is talking about, you know, for some, a security could be restricted by the company. So the companies could be choosing to restrict or hold on to the asset, okay? And so simply there's a sentence in that big paragraph that says a contractual sale restriction is the characteristic of the reporting entity holding the equity security rather than a characteristic of the asset, and therefore is not considered in measuring the fair value of the security. So if the company is restricting it, it's really not affecting the fair value of that security. Now, down below, paragraph 16, that's a restriction on the asset by something outside the company's own doing. So let's say it's unable to be sold on a public exchange, things like that. So, and that, again, there's similar language here. So when the restriction is characteristic of the asset, the restriction is characteristic, it should be considered in measuring the fair value. And obviously that would affect the fair value if it's some inherent restriction of the asset itself. Let's go to the next page there, Kayla. All right, okay, this one gets into residual investments. And this is, again, it's almost like what I'm seeing through the years is as these SSAPs get developed further and further, they're really starting to just fine tune items. So let's face it, our investment marketplace is so complicated in the diversity of investments you can purchase. They constantly have to keep going back and fine tuning these SSAPs. So this one relates to residuals in an investment, okay? So residuals, basically they exist in investments that are backed by a discrete pool of collateral assets. And you can actually have the holders, you can have holders of the residual, and then you can have holders of debt securities that have these residuals built into them, okay? So basically what this is about simply is, it's a complicated topic, but what it's all about is the regulators are like, wait a minute, you know, these aren't being disclosed and reported properly in the annual statement. We want, and that's what this entire page is about, is trying to get any sort of investments that have residual interests in them or residuals in investments reported on Schedule BA. That's what it's all about. They want to see them on Schedule BA. And actually, I think in the presentation, I actually underlined there, and this is all coming out of the regulators' review of the 22 statements. And I guess they found out a lot of these companies, a lot of the companies own or have residuals and investments, but it's not being reported. So That's, in a nutshell, that's what it's all about. There's revisions to 43R and 48, adding paragraphs about this. So that's what this clarification was all about. All right, next page, Kayla. Okay, so we're going on to expose. So those were the adoptions up through September, October. And then here were exposed items at that point, which a handful have already been adopted. And I'm going to note these as we go. So, and also too, to throw out, so there again, there was a meeting in late November, early December. Now there were several items exposed at that meeting, but those are still out there for public comment until early, February, March of 24. So they're really not going to be impacting your 23 reporting or annual statement filings. So as we go through the first exposed item, so this one was adopted, except it's not due and it's not effective till the beginning of 25. And the reason for that, everything is trying to be tied back to this principal-based bond project, which that becomes effective 1/1/25. So you'll see that as a handful of these clarifications and so forth will be have a delayed effective date, but that's because it's trying to tie it into the principal-based bond project. The very first one here, simply this was adopted. This one's really easy, this page and next page. Simply they're trying to clarify and give a little list. You can see the baby blue comments or revisions there at the bottom that are not permitted to be cash equivalents. And Kayla, if you flip to the next page, and that are likewise not allowed to be short-term investments either. So that's what this is clarifying. There's types of investments out there I guess were being reported as short-term investments, cash equivalents, but they're putting out clarifications to explain they are not. Okay, let's go to the next item. Okay. All right, so this item is sort of interesting. It goes on for a couple pages, and a lot of times when I see this usually means, in my world, some of the big boys out there were trying to propose something like this, and so that's what this interpretation is about. Okay, so to slow down, basically, what's underlined here, this one, at the end of the day, this is all about canceling out this concept. So reference 2022-12, okay, is put in place to nullify. You can see they got the word nullify, is to nullify this interpretation. So basically the NEIC said, we're not a fan of this. So basically what it's about is trying to have different valuation or different rules for transferring investments between related parties in relation to pooling, reinsurance pooling contracts. So basically the NAIC is not a fan of this. So that's what this clarification, this reference 2022-12 is all about. It's about canceling this item. But go to the next page there, Kayla. Now what's interesting is, so you can see this is in this paragraph here, that's what the staff status is. They're recommending not to do this. You can see the last sentence I've underlined. Treatment of the transfers of assets between affiliates should be consistent for all intercompany transactions. And there's not a compelling need to be different when valuing assets for intercompany reinsurance transactions, what I just mentioned. But what's interesting is in the notes or the summary from the early December meetings, this one did not get adopted. So and the comment was they're still working with interested parties. So I think there's some pretty strong interested parties out there that are still pushing the NAIC pretty hard on this one for some reason, which doesn't come to me immediately, but that's still in play. So that one's still exposed. Kayla, you want to go to the next one? Okay. All right. Okay. So yeah. So this one is about the wording. I thought was tricky with this one. It's about collateral loan assets. Okay. So when I saw this, I was like, oh, we're talking about a liability, but no, it's collateral loan assets. So
basically collateral loan assets have pledged collateral. So what this is about is, and it's sort of, again, it's sort of one of these obvious ones, I think, but if you understand it, but that's why it's a clarification, is that the regulators wanted to make sure and put it out there in black and white that, you know what, you actually have to have collateral that covers the asset you have on your books with this collateral loan asset. And if you don't, the excess above your collateral is going to be non-admitted. And I guess there were some companies stating that, you know, they didn't believe they needed to do it. So the regulators were pushing this forward to say, look, you know, and it gives additional guidance down below regarding to, you know, if held directly, the proportionate audited equity value shall be used for the comparison of the adequacy of the pledged collateral. So that's what it's talking about. That's what that entire item is about. It's a lot of verbiage, but, and then it even continues to the next page. Kayla, can you go to the next page? Here you go. Yeah, so at the top, there's a new footnote. If you go to SSAP 21, that relates to this. Again, just more guidance related to this, but that's the basic concept. And I want to double check that item was adopted. So I was trying to mention which ones were adopted in the late November, early December meetings. That one related to the collateral loan assets was adopted. It's no longer an exposure. The next one, D, this is just to further define examples of investments captured as non-registered private funds. That one's very minor. That's still exposed though. E was adopted. This was very, very obvious. It's no longer needs to do transition guidance related to post-retirement benefits and pension plan SSAPs because it's beyond 10 years. So yeah, that makes sense to eliminate that. And then likewise, the last item was adopted as well. And this is just, again, giving clarification to identify the investments that are in substance. Again, this goes back to the residual interest shall be reported on BA. So just trying to tie all those reference numbers together related to BA. All right, I want to try to, okay, Kayla, we can go to the next. Oh, we got a polling question. So if your head's turned or something, turn back to the laptop and pick a yes or no, and to make sure if you want CPE, you got to make sure you click a button there. So Kayla, I'll let you, once I see that goes away, then I'll assume we can move forward. But again, for everyone that's online, there's a polling question up. All right. How's it looking, Kayla? I guess, well, once we go to the next slide, I assume we're good to go. So, all right. So principal-based bond project, this has been around for a while, and what I'm gonna sort of basically, Kayla, you can go to the next page. Okay, so simply in general, like I mentioned at the beginning, there's several scope exclusions, modifications, minor edits that from this one project affects several SSAPs, such as 26, 30, 43, 86, et cetera. So, and that all will be effective 1/1/25. So we have, you know, it's not effective 23, it's not effective here in 24, but 25 is when it starts. Kayla, let's go to the next page. I do want to point out probably the last two I want to mention. Okay, so the third to the last item there, it's pointing out there's on a perspective that this will, this is effective in 25, it's going to be on a prospective basis, and reporting is do not have to go back and restate prior year's information, which that's a good guy. Obviously, that's what all of us want as accountants. We don't want to go back. And then likewise, let's see. So there were some exposed items related to this at the very last item, but no major adoptions or revisions to the principal-based bond project took place at the
at the fall meeting, which is, the one at the beginning of December. So really no action related to the principal-based bond project then. All right, I'm almost wrapped up, and then I'm going to turn it over. Okay, so the working group. Yeah, so this is, if you go to the next page, yeah, there you go, Kayla. Yeah, so basically this was during the year. I thought this was an interesting one. So basically the working groups assigned to the NEIC staff say, hey, double check and make sure a broad project to review annual statement instructions, ensure that accounting guidance is included with the SSAP. So back in the day when I started, there were no SSAPs. There was just notebooks of annual statement instructions, and it was literally a hard 3-ring binder. But now, so that's what, and back then as well, that was statutory accounting. What was in those notebooks, and that's what you filed, and that's what you followed. Now, so I guess there's still maybe some legacy instructions in the annual statement instructions about statutory accounting. So this is to do a double check, make sure everything should be in the SSAPs. And I would think it is. I'd be very surprised if there's something out there that's lingering in the instructions. But anyway, that's what that item's about. And then the last item again is this 2019-21, just for the NEIC staff to just take a good look at Schedule BA and any changes that are going to be needed for BA as we go into 25. And that's it. That's it for my portion of the presentation. And Kayla, I think we're going to turn it over to Mr. Straub to go over the blanks.
All right, thanks, Scott. I'm going to cover the blanks working group of what they've adopted and some proposed adoptions that we all can, hate to say look forward to, but will be coming down the pipe. Some of these adoptions relate back to what Scott just reviewed with us in terms of statutory accounting. We'll see here where that statutory accounting as adopted would flow through into the annual statement. And the first one that we're going to talk about is blank workies group 2217, relates to derivative instruments and the disclosures that would be in note 8 to your annual statement. Basically adding here new disclosures related to the current fair value of your derivatives, any recognized unrealized gains or losses, any fair value that's part of the book adjusted carrying value of your derivatives, and the aggregate amount owed at maturity, and the current year amortization and remaining amortization. So those are all changes. You can see they affect Schedule DB and effective for this year's 2023 annual filing. The next one is 202301. It relates to pet insurance. I don't know how many of our folks here on the line here have pet insurance, but previously the instructions were that pet insurance was part of inland marine line of business. I'm not quite sure why it ended up there, but they've decided they're going to break out pet insurance, probably becoming more prevalent, seeing more of that business. So you're going to see pet insurance as a separate line of business in schedules related to premiums and losses and that sort of thing, including the state pages. So that'll be something effective beginning with your quarterly filings in 2024. Next thing we're going to talk about, and this is probably one of the bigger changes, it's 202302, and it relates to a new exhibit, a new supplemental exhibit, which will be due March 1st, and it has to do with market conduct exams and information they're gathering. Typically, all that stuff was part of a data call that everyone had to file, but for whatever reason now they want to try to accumulate some of this information into a separate supplemental exhibit of the annual statement. It's not really financial in any respects, but it is part of your annual filings. It'll be due March 1st. Kayla, you can flip to the next page. What you're seeing here is an example of that exhibit. It's pretty basic, but what you need to know is that you will file this for each of the states that you do business in. And you can see there they have lines of business itemized, 1 through 12, disability, income, health, homeowners, and so forth and so on. And you would mark either yes or no in that second column as to whether or not you have reportable premiums in that state by line of business. So there's going to be the need for a certain amount of knowledge about what what amount of premium that would breach the threshold that would require reporting under the market conduct rules. There is a separate web page out in the NAIC website that provides additional information, but I think as you've been filing for these data calls in the past, you should all have a pretty good understanding of how this schedule would be completed, but it certainly is going to need to, you're going to work with the people that have been filing those data calls in the past to make sure you get this schedule prepared properly. On to the next page, Caleb. Couple easy ones here, 202.304. There's new information related to appointed actuary and qualified actuary contacts as part of the jurat, but it's electronic only. So that's an easy one to miss since it's electronic only. Information doesn't get printed in the printed jurat. Easily to miss. We usually assume most of that data is pretty stagnant from year to year. So just make sure when you're starting your annual statement preparation process, you go in there and enter the information required for your appointed actuary. 202.308 is just some clarifying language. It relates to Schedule Y Part 3, so your work chart. And they just felt that they need to clarify that if you have a mutual company in your mutual holding company structure, they should be included. I'm not quite sure. I guess some people were assuming that a mutual company, since it's not owned by virtue of stock, it would not be part of the mutual holding company structure, but it is, and that will be effective for your year-end 2023 filings. The next item goes back to some of the adopted accounting that Scott mentioned, 202.311, relates to footnote 7, investment income and additional information to be gathered there. In that footnote, it includes amounts excluded, i.e. non-emitted, so investment income that or accrued income that is non-emitted, or deferred or received as a paid-in-kind asset of some sort or another. So all that would be part of now note 7 in the annual statement and effective for this year end. Shayla, next page. This is one of the other big change that we're talking about in a new exhibit that's part of the annual statement. It's a supplemental exhibit for other liability lines of business. So we're in the state pages of the premium and loss exhibits where you have data on other liabilities, 17.1, 17.2, 17.3. You have data in those lines. You now need to complete this new supplement, which will again be due March 1st for this year end. And you can see there's quite a bit of breakout of what they're doing with other liability lines of business. And you can see there's really 12 lines in the main exhibit that we have here. You can see the various categories that they've come up with: completed operations, E&O, D&O, environmental liability, all the way down. If you look at, and this is what you need to be careful with, is line 9 is actually references an aggregate write-in for facilities and premises. So what you have there is in the details of write-ins, if you have anything that relates to facilities and premises, and you can see CGL, commercial general liability, you have to further break that down by various categories, and we'll go through those in a minute. So you can see this exhibit. You're supposed to provide information for written premiums in the prior year. That's column 1. Column 2, 3, and 4, those are all current year data. Again, current year premiums written. Column 3 is direct losses paid after deducting salvage. And then losses unpaid, case basis. No IBNR needs to be allocated in this exhibit. Makes life a little bit easier, I think. Again, all this is due for this year. Yeah, I've talked to a couple of folks about starting to gather this information. Part of the problem may be, in the instance of the one client that I'm thinking about, this breakdown that they're asking for hasn't otherwise been captured in their systems all these years. And so I think in that situation, that client probably won't have the detail that they're looking for last year and this year, but they're making changes to the system and how they code things so that going forward, they'll start to capture this information properly. Now, going back to that line 9, aggregate write-ins for facilities and premises, they also provide us, the NSC did, with a bunch of different extra categories for that line. And Caleb, if you flip to the next page, there's actually 12 different categories that you would segregate that facilities and premises into. And they're itemized there, a whole bunch of different things: construction, contractual liability, elevators, liquor liability, all the way down through to veterinarian, item number 12. So if you have anything that is facilities and premises, you then, in that exhibit that we just saw on the previous page, you need to break that down by these categories. They would be write-ins, so we write them out, put them in as necessary if you write this type of business. It makes me wonder why they just didn't put all these lines in the exhibit itself and make these aggregate write-ins. But nevertheless, they chose to do it this way. So this again is something due March 1st for your year-end filings this year, and you may have some difficulty gathering that data. So you start to need to start talking to your IT folks and systems and see if you have this data that you can categorize other liability in all these different buckets. The next slide, Kayla. The next one relates to RBC and affiliated investments. And there's other changes in RBC like there are every year. They change the risk factors for underwriting and losses and all that. But this is a big change. If you do have an affiliated investment, they've made some changes to revise instructions and how the structure of these pages work. It's PR 003 through 05. And it makes them consistent with the treatment of affiliated investments that you would see in health and life and P&C. So they'll all be the same. They won't have any variation in how they capture data and what data is captured for affiliated investments for RBC. Next slide, Kayla. Here's a couple of things that have been talked about and were basically re-exposed. When we get to the last one, it actually relates to the bond project, and we learned earlier that's actually been adopted for January 1st, 2025. But the first one relates to changes to the cybersecurity supplement, removing references and removing data for identity theft. So if you are filing that cybersecurity supplement, that'll be a pretty big change to remove anything related to identity theft and references to it, et cetera, et cetera. The second item, again, deferred for comment, which I think is welcome. They're looking at changing and deleting information in Schedule D, A, B, BA, D throughout. Is that LEA information? So we don't normally get the NAIC deleting information requests, so we're always happy to see that. And so hopefully this is something that gets adopted in the future. There'll be a little bit less information that we would be required to file in the annual statement. And again, that last page relates to the bond project. Very significant changes to Schedule D. We'll be getting more information out to everybody about that. But for now, we've got a year or so to think about that and get ready for the changes in the annual statement related to the bond project. Next, Kayla. Okay, I think we're going to turn it over to Carrie at this point.
Hi, everyone. So there are a few items that we wanted to talk about from a tax perspective. The first relates to an interpretation around the corporate alternative minimum tax that came out as part of the Inflation Reduction Act that was enacted in August of 2022. So if you haven't heard of the corporate alternative minimum tax, it likely does not apply to you, because I think anyone that is an applicable corporation has been basically living in this over the past year. So the new corporate alternative minimum tax, otherwise referred to as CAMT, not candy as my kids like to say when they hear me talk about it, but CAMT is effective for tax years beginning after 2022. So this is the first year that it is effective for applicable corporations. So a high level of the corporate alternative minimum tax, for those that have not heard of it or not fully aware of what it is a minimum tax that is based on 15% of financial statement income. So this is similar to the prior alternative minimum tax that we had in place prior to the Tax Cuts and Jobs Act, but this time it's based on financial statement income that is exclusive of other comprehensive income. So who is applicable to this new corporate alternative minimum tax? It is a determination that's made on a tax control group basis. So for the most part, it is corporations that are part of a controlled group, some that file a consolidated tax return, and it's based on, it's for corporations that have average annual adjusted financial statement income in excess of $1 billion for the 3 prior taxable years. So the thing about CAMT is once you are a CAMT, an applicable corporation, you're always an applicable corporation. So that there are certain exclusions to that, but that is the case right now with CAMT. It is thought that there are going to be less than 150 corporations that are actually subject to CAMT. So because of that, this guidance under interpretation 2303 was developed as an interpretation. Kayla, can you move on to the next slide, please? The one thing for everyone to know about this interpretation is that it does provide for 3 categories of reporting entities. So we have non-applicable reporting entities, which the majority of you would fall under, and then applicable reporting entities, and the third one is applicable reporting entities with tax allocation agreement exclusions. So I'll touch very high level on the applicable reporting entities considerations. I know we have a few on the call that may be subject to CAMT. But if you have determined that you are subject to CAMT, you are required to consider that now for year-end 2023 in both your current and deferred tax calculations. So this may or may not result in different current and deferred income taxes depending upon whether or not you actually have the alternative minimum tax. I will tell you that for taxpayers that are applicable corporations, this could be a big deal. We're currently working with a company that is subject to CAMT and has an additional $300 million liability for the year related to this alternative minimum tax. So definitely a big deal for those corporations that are required to do this calculation. So if we do have CAMT payable, you do have to include that now in the calculation of your current income tax expense. It has to be done in accordance with your tax allocation agreement. So I think the biggest consideration with this interpretation, if you are subject to CAMT, is really, it's about your tax allocation agreement. If we can move on to the next slide. If we do have current CAMT payable, that does create a CAMT credit deferred tax asset. So this is a non-expiring tax credit carry forward, which is equal and offsetting to the current CAMT that's accrued, and that's for the first year. So this CAMT credit carry forward creates a new deferred tax asset. And as with any deferred tax asset, we have to then consider both valuation allowance considerations and then admissibility considerations. So with the valuation allowance considerations for your CAMT credit deferred tax asset, it is going to be dependent upon whether or not you're part of a consolidated tax return group or a separate filer. So if you are part of a consolidated tax return group, you have to consider the valuation allowance consideration as a full consolidated group. So that's the main thing to remember there. And then you can also develop an accounting policy election to either consider or disregard your CAMT when you're looking at whether or not you need a valuation allowance for your non-CAMT deferred tax assets. So those are the main valuation allowance considerations. And then for admissibility, if you are part of a consolidated tax return group, you have to look at whether or not the group qualifies for the credit and when the group can utilize that credit. So that's the main thing to look at. Even if you have a separate calculation as a reporting entity, you have to consider the impact of the overall consolidated group. And if your CAMT credit carry forward doesn't qualify for admission under the second test 11B, then you can consider looking at it under 11C. So if we can go to the next slide, there is transition guidance related to this interpretation. The first one being the amendments to your tax allocation agreements, which once again, I'm sure whoever is attending that is subject to CAMT, you have been looking at this for filing Form D. And then the initial application of this interpretation is not considered a change in accounting principle, but it's the application of a new principle for the first time. So everyone on this webinar, there is something for us to do, even if you are not an applicable corporation. There is a disclosure that you are going to be required to include, and that is what type of entity you are as it relates to CAMT. So the majority of the corporations on this call will be a non-applicable reporting entity. So that is something that you'll have to include this year on your year-end financial statements and annual statements. There are additional disclosures for your applicable reporting entities, including whether or not you made an accounting policy election to either consider or disregard CAMT when evaluating your need for valuation allowance. And then if you end up making any material modifications to your methodology used to project your CAMT. This is effective now with year-end 2023 financial statements and going forward. So that's the key thing to remember there. All right, we can move on. So that brings us to our next polling question. Is your company subject to CAMT? And I guess if your answer is I'm not sure, definitely something to start looking into before the end of the year, because there's a lot that will need to go with that. All right, for those that said I'm not sure, feel free to reach out and we can definitely discuss. All right. So the other item that we wanted to talk about today relates to Section 174. So 174 was actually part of the Tax Cuts and Jobs Act that amended Section 174 to now make the capitalization and amortization of R&E costs mandatory, and they are amortized over 5 years for US costs and 15 years for foreign costs. So I know our clients have probably heard a lot about this over the past year. Definitely something that we were discussing with everyone because it was a change that was effective 1/1 of 2022. The key thing to know here is that for the 2022 tax return filing period, we didn't have all the guidance needed to really do a full calculation of what we needed to capitalize under the new Section 174. So Notice 2023-63 came out in September of 2023, right before the 9/15 filing deadline. That provides interim guidance now that we can follow pending proposed regulations. So if we choose to follow this notice, it has to be applied in full. Main thing here is that it did provide some clarity in determining what's considered research or experimental expenditures. So labor costs basically includes everything other than severance. We have materials and supplies costs that are used and consumed in the performance of R&E activities, certain cost recovery allowances, and other costs such as patent costs, management costs, and travel. If we go on to the next slide. So this is the key slide for insurance organizations, because this is the majority of where our clients saw the capitalization of R&E expenses is really in computer software development. So we did get some clarity on what was considered software development under this notice. So activities that you would have to capitalize the cost for and amortize includes planning the development of computer software, designing computer software, building models, writing source code, and testing up until the point that the computer software is placed in service, ready for sale, or production of the product master. Some items that are not considered software development for purposes of 174 would be training employees, maintenance activities after the computer software is placed in service. That doesn't really give rise to upgrades or enhancements, certain data conversion activities, and installing the computer software. So on the next slide, so considerations for 2023 year end, the status of the proposed regulation. So the notice came out and gave us interim guidance. We're likely not going to see proposed regulations until sometime early 2024. When the comment period ended for the notice that came out, there were over 500 comments. So now, they have to go through the 500 comments, put together proposed regulations, and then final regulations. So I think this is something that we will continue to talk about over the next year as we continue to see more guidance come out. Accounting method changes. So for anyone that did capitalize and amortize R&E expenses and included this statement with their return in lieu of the 3115, I foresee everyone making some kind of adjustment to true up to the notice and regulations. So I think what's going to happen is we're going to be able to do this in the form of a 481A adjustment. So that's definitely something to keep on your radar that will be coming up in the future. And then the last thing is just to keep in mind research and development tax credit. So if you are looking at your R&D expenses anyway to figure out your capitalization and amortization. That's something to keep in mind, because if you're doing the work for 160 or for 174 anyway, you can definitely potentially get the benefit of a credit. We worked with a company this year that, now that we had to look at it for 174, they decided let's just look at it for the R&D credit. They ended up with close to a $300,000 R&D tax credit for their software implementation. So keep that in mind. Feel free to reach out if you want a scoping on that, and we can definitely discuss. And with that, I think we are going to move over to Ryan to talk about, one quickly, bonus depreciation used to be 100% in prior years. That is being phased down now at 20% per year. So when you are looking at your fixed assets for the year end, it is down to 80%. So it is something to look at, to consider going back to 179. So that's just a bit of planning. And now I think we are going to move on to Ryan to talk about CECL.
Yes, thank you, Carrie. So for the current expected credit loss standard, this has been out there for a few years now. This is going to be the first year when it applies to entities that aren't publicly traded. So with regards to the standard, at a very top level, what the FASB was looking to do here is, if you have any kind of financial asset on your balance sheet where you could potentially have a credit loss, so they're not going to pay you what you're owed, they would like to see a reserve for that. And so there were certain assets where we didn't typically put up a reserve for a credit loss in the past, that under this standard now, they would like to see a reserve up. So under the legacy GAAP, for bonds, for example, for OTTI, we'd usually wait until a loss is probable. But now they want you to do an analysis to potentially create a reserve for future losses. So they really want to have you have on your balance sheet allowances for any future credit losses, and they want you to do an analysis in order to try to come up with these reserves. So at a very top level for insurance companies, I think the big three areas that would be affected are held to maturity debt securities, premium receivable, and reinsurance recoverable, which is one we're all very familiar with because of statutory requirements over reinsurance. So in terms of exceptions, just a few interesting exceptions is noted there is U.S. Treasuries and Fannie Mae, Freddie Mac. If you hold those bonds, even though you have a financial asset in a bond that could potentially have a write-off, those aren't considered to have credit exposure. I think also if you have related party transactions where you have common control as defined by GAAP, you don't need to take a look at those transactions, so intercompany reinsurance. Available for sale debt securities, we have a slide on that later. That also got updated with this ASU, but it's technically a separate framework. So next slide. Thank you. So yeah, the reporting model, again, for any financial asset where you could potentially have a credit exposure, they want you to come up with an allowance, similar to allowance for bad debt that we are all familiar with. And so basically you want to create that allowance for any asset that you have at cost, and then bring the change in the allowance through your income statement. This standard does want you to pool your assets, so it wants you to take similar assets and pool them for purposes of the analysis. So for example, with bonds, you'd want to pool your bonds by different categories or types of criteria. So if we could go to the next slide, Kayla. So when they talk about that pooling, here's an example of some of the things you could potentially use to pool your assets to help you get started on an analysis, things like credit rating, asset type, time to maturity. You're trying to create a risk pool basically for those particular assets that then you can do an analysis for. And you do have to look at the assets within each one of these pools at each balance sheet date to make sure you don't need to move things between pools, or an asset is no longer, sharing similar characteristics to the other assets in that grouping. So next slide, Kayla. So you will have to get your hands on data for this. I think this is a big challenge for this standard. On the next slide, we'll talk about held to maturity bonds. You need to be able to group your bonds, and perhaps you'd use something like credit rating and time to maturity to group them, but you are going to have to get some data, both internal and external, on what your exposure could be. So you may need to get access to historical write-off percentages from a data source to serve as a baseline to potentially create a reserve. Others, you might have enough data internally to do that analysis. So next slide, Kayla. So GAAP doesn't tell you a specific method to use in order to do the analysis. They do give you a little flexibility. to pick a method and also in some degree right-size it to your organization. So these are just two methods that you could potentially use. I'll touch on the loss rate method. That is a method where basically you could group similar holdings like bonds or your reinsurance recoverables and figure out a criteria that you want to use to group them, like their rating. And then you can use your historical information in order to come up with a baseline for a potential reserve in terms of if you've ever had to write it off or what write-off percentages may be for those types of assets in general. And that can help you build an expectation on what a reserve may look like. So we can go to the next slide. So again, some common holdings for insurance companies, held to maturity debt, grouping them and coming up with an allowance, adjusting for information as you gather it. Premium receivable could also be analyzed, of course, and then your reinsurance recoverable, looking at your reinsurers and deciding, how you're going to group them and analyze them to potentially create a reserve or an allowance that you'll bring through the income statement for changes in it year over year. Looked at a few public entities. I think Chubb Limited had a really good write-up on their analysis for these, so that's a really good reference point. Obviously, you would right-size that to your entity. They might have more data or complex analysis given their size, but they have a good write-up on their approach. So next slide. So for adoption, it would be the beginning of this year for non-public entities. In your disclosure, you're then going to disclose how you analyze your pools of assets that where you could potentially have a credit loss exposure. And then basically you would perform a roll forward of that analysis. So next slide. As I mentioned, available for sale debt securities also got updated. The guidance there is technically separate from CECL, but now basically GAAP wants you to figure out if you have a asset, let's say a bond where fair value is less than amortized cost, you want to figure out if any portion of that fair value decline is credit related, meaning that you don't expect to get back the capital that you put into that bond. And to the extent you need to have that for, not being able to get that back, you need to identify that portion of it and bring that portion of the decline in fair value through your income statement versus the other types you would just bring through your OCI like previously. So next slide, Kayla. And then this is not applicable to statutory accounting. I think they'll make a lot of people happy on the call. And actually in the December working group, they exposed to reject CECL for purposes of statutory accounting. So at this time, it looks like it's going to be a GAAP concept. Slide. I believe this is the poll question, the last one. And Scott, I think I'll turn it back to you here since this is close to the end of the presentation.
Okay. Yeah, Keela, when that comes back up, I guess we can all, there you go. There's the answers. Yeah, Keila, I guess we could all pop back up, all the speakers here. And do we have any questions that came in?
I think you guys must have done a really exceptional job because right now there are no questions.
Well, very good. Very good. Well, I do want to point out how professional we are because we stopped at 2:59. So we only had, we had this down pat. So we don't like to go over. So, well, I guess simply thank you for everyone attending. Here's again within the slide and the information that Kayla's going to send out is all of our contact information. If anyone has any follow-up questions or anything we talked about today, feel free to reach out to us. And thank you all very much for joining us and have a happy holidays.